Hi, you guys. I'm Phil Town from Real One Investing. Earlier this week, I hosted a live hour-long Q&A session. I answered questions that all these people had about the results of the 2020 election, what it means for the stock market, and a whole bunch more. And now I'm going to share this with you guys, and this is going to be the highlights from that section. So let's jump in here. Let me just briefly introduce the subject. We're going to talk about not the politics of the 2020 election, but the impact of the 2020 election on the economy, more importantly, on the stock market, where we think we're going. And let me just start off by saying that the stock market already responded really dramatically to Biden's election, and I honestly to God think it would have responded the same way with Trump. It's just responding to a lowering of uncertainty, and I think that's the key thing. You lower the temperature of uncertainty, the stock market tends to go up. I think both parties are going to be interested in really having another very hefty essentially buyout of all the people who are struggling to kind of keep their businesses going. They're going to jump in there and help them with some significant government money. Pelosi's offering up about $3 trillion. Trump was ready to go for $2 trillion, and McConnell's ready to go for $1 trillion. So as we go into this new government, what I think we're going to see is more of the old government, although with less restraint. And so it may accelerate all of these things we're talking about. Now, what's going to happen in the stock market? Nobody knows, because we've already blown this balloon up so enormously. And look at what happened. I mean, balloons are just waiting to bump into some sharp object, right? And pop. And the sharp object came along in the nature of a COVID pandemic. It was a sharp object. And you saw what happened almost immediately. The stock market just cratered 37% and then reflated. So that sharp object didn't reach the inner balloonness in us, and having nowhere else to put money, people put it right back into the market the moment they were clear that the federal government was coming to the rescue, and coming to the rescue with whatever it had to do to come to the rescue with. So that's where we are right now, and it means that we don't have any fiscal conservatives left. The Republicans have given up that ghost when they brought Trump in. Trump is about as fiscal as any left-leaning Democrat. Trump is a believer in small government, but not small spending, and he's a believer in low taxes, which increases the pressure. So we have already seen we've had years of big spending, right? We have had years and years and years and years of big spending. I mean, George Bush took us into a couple of really stupid wars again, much to my amazement. Having been a Vietnam veteran, I thought, well, that's the last we'll ever see of that in my lifetime. And that turned out to be wrong. So we blew up a couple $1 trillion in the desert, and not to mention the lives we've ruined over there. So that was great. And then Obama came in, and they just, basically printed money like crazy to fill in the near depression we went into. And I mean, Bush started doing the printing, and Obama just kept doing it, and to the tune of $4 trillion. And he had a lot of economic advisors. Paul Krugman was yelling at him to just keep printing, right? Paul's a left-wing Nobel Prize winner in economics. And he writes in the New York Times, and he was like, you haven't printed enough. And Trump made that clear that was actually true. And Trump didn't print so much as just cut taxes, which put a lot of money in people's pockets and had the effect of, basically printing more dollars. But why? Well, because we're running deficit spending in the federal government. We didn't have enough money to pay for the programs that we've decided to do. So we are going for more of the same. There's very little doubt in my mind we're going for more of the same, and we're going to keep going for more of the same. There's no fiscal conservatives left. Everybody understands to get elected, you got to pay. It's a question of how much, and and it's all a political game at this point, as far as I can see. So the thing that we're headed toward, you guys, I believe, is that the rift between the haves and the have-nots will grow faster and faster. It grew fast under Obama and Biden. It is going to grow, and then it grew fast under Trump, and it's going to grow fast under Biden. And that's just because as you pour dollars into the economy, the people who get those dollars are the people who ultimately have profit, right? The wage earners, they're just spending money, and it ends up in the hands of people who own the assets. So in this world of haves and have-nots, we're going to see a lot of social strife, regardless of the fact that the Democrats won. It'll get worse. So you want to be an asset owner in this environment. You want to own things that will appreciate as the dollar is devalued. And those assets include gold, which is a pretty obvious asset to own. Now gold isn't an investment. Gold is a hedge on a currency. It's a currency, and we're going to choose to have some of our capital in gold as a currency rather than in dollars as a currency. And we will be hedging the dollar with that gold in the belief that this devaluation will continue. So there's a currency. Silver is a currency. Gold mines and silver mines are assets that will appreciate rapidly in a currency devaluation environment because the value of the thing that they're pulling out of the ground is increasing day by day in that environment. So those are all good ideas for this sort of scenario. And the next level of idea is a commodity related, right? So gold's a kind of a commodity. Other commodities include farmland, companies that make money out of farming, out of food production, cattle, companies that provide it, companies that put it out there. So that group of companies might include, companies, I don't know, like Smithfields. I guess they've been sold to the Chinese, but companies that actually produce hard goods, food that people will need and will pay for, are going to do pretty well. And by the way, just as an aside here, you've got to be very careful about the companies you're choosing, because while you may want to take on debt as an individual citizen, you have to be very careful of getting into a company that takes on a lot of debt and maybe takes on too much. So we want to be very aware that some debt is okay, but too much debt can kill. And the reason for that is that these companies, if they get into trouble, their CEOs will have no problem whatsoever taking the company into Chapter 11 bankruptcy to unload the debt. So they'll just dump it rather than having to worry about paying it off. They'll use the social strife, they'll use the volatility of the markets, whatever, as an excuse, and just unload the debt by Chapter 11, and that wipes you out as a shareholder. So you want to be very careful about the kinds of companies you own in that environment. You want to own debt-free companies or companies with very low debt, couple years of free cash flow kind of debt. And so you want to own companies that are producing commodities. Now, the trick with commodity-type production companies is they tend to not have a moat. So be very careful in choosing these companies. There are some that do, by virtue of their means of production, their control of mines. For example, Cameco up in Canada has a kind of a big moat because they have the best quality uranium mines in the world, and you can't dig uranium cheaper than these guys can dig it. CF Industries creates nitrogen fertilizer for farmers in the United States and North America, and it does it at a much cheaper price than even the Chinese can do it. They have fabulous production structures that give them the low-cost producer, and they can keep lowering their price and still make money when everybody else is losing money. So we want to look at companies that have those kinds of capabilities if we're looking at commodity-type companies. Then we want to look at companies that are going to be successful in the form of an anti-fragile type business. And that means a business that gets better when the world gets into really deep problems. So deep problems in the world almost inevitably mean conflict between countries, either warm wars, hot wars, or cold wars. And we've seen that start up already. We've starting to see a little bit of a cold war up on the border between India and China. Those guys are up there throwing rocks and won't stay throwing rocks forever. And we're going to see more of that. We're seeing China push into the South China Sea, which are important sea lanes. The United States doesn't want to lose those sea lanes or have China control them because of trade, right? All the way through to all through the southern part of Asia and Australia, New Zealand, as well as getting down into Africa. So you've got important sea lanes, and the United States is essentially using Taiwan as a reason to have a Navy out there to protect those sea lanes. And so when you start having lots of people with guns and bullets fly around each other, getting angrier and angrier, you can end up in a hot war. So when you have all of this conflict out there, then you want companies that are anti-fragile. You want companies that do really well when it hits the fan. And so that would be companies that have a defense capability. That is, they're making products for national defense or national armaments. You want companies where people are looking for some means of self-defense when volatility in the social fabric is being torn apart. People are looking at self-defense and things that will provide them with more safety at home. So again, you're looking for companies that are anti-fragile, that will do well when it really starts to get bad out there. In the future, we're doing some research now to just kind of look at the 30s. We've been digging into this for quite some time, at companies that did very, very well from 1930 to 1945. And those of you who are in our advanced classes would certainly, of course, make those available to you guys. So what else? Okay, then there's a fourth category, and that is simple pleasures. So again, when you're looking at anti-fragile companies, one of the things you should look for are companies which provide pleasure for a very low cost. Back in the 30s, movie theaters did very well. Movie producers did well. So did Coca-Cola. It did extremely well. So did Revlon, making makeup, did extremely well. So you're looking for things that don't cost a lot of money, but they give you a lot of pleasure. And those companies tend to be very anti-fragile when things are really rough. Now, you're not looking for a company necessarily that's going to do better in the Depression. That'd be ideal. For example, defense companies, of course, will. But you're looking for a company that's going to make it through and carry with it the value of your assets, the value of your money. And so those are all ideas that we have come up with, and I hope that's helpful for you. All right, you guys, now I'd love to hear from you. Did we miss any of your burning questions? And if we did, just leave a comment below with your question, and I'll be sure to follow up with you. And thanks for watching, you guys. Now go play. If you enjoyed this video and you feel it was valuable in teaching you more about the impact of the 2020 election on the stock market, just hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks again for watching.